let's go over bank accounts. Now, we're going to just go through this as if you don't know what bank accounts are, but chances are you probably already have one or more. Bank accounts are simply accounts that we can open with a bank, as the name implies. But they allow us to deposit our money into those accounts, one, for safekeeping, but two, to get some form of return or profit in the form of interest. These interest payments are small little thank yous for depositing your money with that bank. And how much interest you get depends on the type of bank account you have. So let's quickly run through some of the most common types of accounts, starting off with a checking account. If there is one bank account you have, it's probably a checking account. These are the most common type of bank account, and they allow us to deposit our money that can be quickly accessed through various means such as an ATM, if we want to withdraw cash, or by paying for things with a debit card. When we want to be able to spend that money, it is always there, ready for us to spend. But the trade-off is that these checking accounts, while they are convenient, offer basically zero return, with the average return of a checking account giving around 0.1% interest. Compare that to the average rate of inflation around 2 to 3%. You're not exactly growing your money, are you? So if we want slightly better returns, but slightly less convenience, we can turn to savings accounts. Savings accounts are often offered in addition to a checking account, and it comes with the caveat that, for the most part, you can't spend money directly from this account. Sometimes your bank will allow you to do 4 or 5 transactions a month out of your checking. Otherwise, if you want to be able to use the funds in that account, you would need to transfer them over to your checking account. So, slightly more inconvenient, but that inconvenience comes with slightly higher reward, with the average return for these accounts offering around 0.5% interest. Better, but I think we could do even better than that. Now we get to talk about a slightly newer idea, known as a high-yield savings account, or you'll often see it abbreviated HYSA. These accounts offer significantly higher interest rates, where they might even get up to the range of 4 to 5%. The reason that they can offer these rates is that they're typically offered by online banks. When's the last time you drove down the street and saw a Chase or a Bank of America? Probably pretty common, right? But when's the last time you saw a SoFi Bank? No, I'm not talking about the stadium in Los Angeles. We're talking about a physical SoFi bank. Never. Because SoFi is predominantly or primarily an online bank. They reduce their expenses by not having bankers, by not having buildings, mortgage, upkeep, and all of those things that Bank of America and Chase have to pay. So instead, they try and pass on some of that savings to you in the form of higher interest rates. So, lower expenses means better rates for us. But I know you're probably thinking, the nice thing about a big shiny bank is the big vault they stick my money in. Spoiler alert, they don't actually put your money in that vault. But the same idea applies. Are these online banks actually safe? Is my money safe in these accounts? Can the bank steal it? Can the bank fail? What happens to my money if the bank fails? Don't worry. The answer to all of these questions is, well, it's not 100% yes. It is 99.9% yes. So 99.999% of the time, your money is safe in a high-yield savings account, or a savings account, or a checking account. And the reason is that you don't have to trust the bank to have your back. You can trust good old Uncle Sam. Whatever that's worth for you. But in reality, there's nothing stopping a bank from failing. But in the event that they do, your money is protected. There is a group known as the FDIC, the Federal Deposit Insurance Corporation. They work with banks to provide insurance for account holders, where each one of your accounts with a bank is insured up to $250,000. So, that means if you deposited $100,000 with a bank, and that bank went bankrupt, the FDIC would insure the entire value of what you had in that account. So, is there still some risk? Yes, but the risk isn't that the bank fails or not. The only way you would lose your money is if the FDIC, or by proxy, the United States economy and the United States banking system fails as a whole. And if that happens, I think we've got some bigger issues than our small checking account.